In the last policy announcement on 29 October 2013, the Reserve Bank of India forecasted a slower GDP growth of 5% for the fiscal year of 2013-14. The bank's priority is clearly to control inflation ahead of facilitating growth. The effect of current credit tightening by the Reserve Bank of India is likely to control inflation by the fiscal end. WPI inflation is expected to come down to 5.3% by the fiscal year end from the current levels of 6.5%. India's IT/ITES exports grew in the third quarter, and that's a good sign. This is despite Indian rupee being strengthened against the US dollar. With increase in India's IT exports, there emerges hope to developers having constructed the office buildings, since 40% of India's office space is leased by IT/ITES companies. Office markets. India is going through a tough phase. The projects are deferred, are being constructed belatedly, and there are hardly any new projects launched. With this correction in supply and the steady absorption, some of the Indian cities will start experiencing drop in vacancies. Mumbai, Chennai, and Pune will demonstrate this trend, whereas Bangalore and Hyderabad will more or less remain the same. NCR, however, will have worsened vacancy levels. The annual absorption of office space in India for the next 3 years will hover around 27 million square foot mark, just about 10% lower than India's long-term average of 30 million square foot of absorption. All cities now have a trend of different market dynamics at the same time. Within cities, there are neighborhoods which are occupier friendly, neighborhoods which are neutral, and also neighborhoods which are landlord friendly. The different vacancy levels and forthcoming supply are the reasons for this varied performance. Occupiers in the current year have preferred leasing space in completed or nearing completion buildings. The trend of pre-leasing in under construction projects or newly launched projects has withered steadily. This is on account of reduced faith in developers to complete the projects on time, and also the narrowing delta between the rents in under construction projects and completed projects. India still offers a very competitive rents compared to the Asia Pacific cities as well as the global benchmarks. It is only Bangalore and Chennai which are closer to the pre-GFC peaks of rents. All other cities are still trading at a hefty discount. This competitive rents is a positive factor for international occupiers taking space in India. In terms of yields, there is a compression in yields with capital prices growing more than the rental growth observed in the last 3 quarters. Retail markets. This year, and particularly the third quarter, demonstrated healthy absorption of retail space. This is on account of completion of more relevant retail supply. Right quality of supply at right locations was the main reason why there was a significant improvement in space absorption of retail projects in India. Next year, we anticipate more traction, more relevant supply is going to get operational next year, and with FDI opened up and international retailers doing their homework this year, we anticipate more action on field next year. The first 3 quarters have shown steady decline in both the new launches of projects as well as the sales of housing units in India. This is contradictory to the usual trend that India shows of increasing new launches and sales starting from first quarter to third quarter of every calendar year. With dipping sales and swelling inventories, the last quarter of this calendar year is perhaps the last hope for developers to stay afloat. Otherwise, correction in price is imminent. Bangalore and Chennai continued to show good performance with good traction on field of new launches as well as sales. Hyderabad, on the other hand, went back into shell with political uncertainty and slight issues of law and order. All other cities, the inventory is swelling. 2 cities that performed better in third quarter than before are Mumbai and Bangalore, where the outstanding inventory reduced. Despite high unsold inventory, prices correction has not really happened. It is in form of discounts in kind, waiving off of preferential location charges, absorption of stamp duty and registration, etc. But no direct price cut is so far observed. We believe that in the festive season, if sales don't pick up, the price correction is imminent.